Hey, what's up everyone? It's Griffin here. So as a Canadian property owner and real estate investor myself, well obviously I'm always trying to stay on top of really just what's going on in the Canadian real estate market while also trying to share as much of my own knowledge and experience as possible through my videos so that hopefully everyone watching can at the very least try to get their foot in their door when it comes to real estate investing and or home ownership over the next couple of years. Real estate's been a huge contributor to the overall growth of my investment portfolio over roughly the past 4 years or so, and I also fully realize just how important home ownership is to the average Canadian, so it's a very important topic to cover. The thing is, if you weren't already in the game ahead of time or haven't had the opportunity to purchase a property over the past couple of years before that meteoric rise in price points, well, things can maybe seem somewhat bleak and also like you're just running on a hamster wheel, trying to continue saving and investing enough to catch up to those increasingly large down payments as well as lowered overall home affordability. After all, average property price points have been increasing at a much quicker pace over the past several years than the average take-home income, which simply means that it's essentially increasingly difficult for everyday people to secure a property in the first place, but then on top of that, continue to maintain those payments over the course of the loan. Bottom line, the Canadian housing market is completely out of control and right up there in the top 5 hottest housing markets across the world. Realistically though, if you watch my channel, that's probably nothing new, right? But now that we're entering into the second quarter of the year, interestingly, the average price point across the country is starting to pick up again, which I'm sure is not the information that you wanted to hear out of this video, but that's also despite the number of overall transactions also starting to pick up, which is kind of interesting. You would assume that with increased inventory and transactions, prices would stabilize a bit, but that just hasn't been the case, at least not yet. In fact, this chart shows us the average sold price in orange and the number of transactions in blue for the entire Canadian market and across all property types. So this includes freehold homes, semi-detached homes, condos, and so forth. The problem is that despite a small little surge in transaction volume in February, well, average property prices have continued climbing towards all-time highs to a point where the average home price in Canada now sits at $816,720, which is up over 20% from last year. Now, do keep in mind that this overall national average is somewhat skewed by Vancouver and Toronto specifically because prices have just increased so much. So in other secondary markets, things aren't as intense. But hey, if you are brave enough, maybe you can move to Yukon. Prices have actually declined by 1.5% year over year, which is pretty impressive. Obviously, I'm joking, you don't have to relocate to the Yukon, but overall, year over year, this is the highest price growth that the Canadian housing market has ever seen. And despite the fact that yes, this is completely out of control, it's completely unsustainable, and overall was not something that was predictable in the first place, well, this is still one of the compelling arguments as to why home ownership truly is typically one of the best investments that the average Canadian investor can make over the course of their lifetime. Sure, the past couple of years have been completely above average, but even if we project that out over the past several decades, we can see that overall the price point of houses appreciates quite consistently year over year, especially when you're holding your family residence, let's say, for multiple decades. Of course, yes, there are ongoing expenses with home ownership, and yes, at times, from a strict financial standpoint, it can make more fiscal sense to rent. However, the data just shows that over years of owning versus renting, typically speaking, just the forced savings mechanism of owning a property alone is extremely powerful. So years down the line, everyday middle class people end up with hundreds of thousands of dollars of just dormant, lazy equity in their properties doing absolutely nothing. In fact, home ownership is the main element contributing to everyday middle class individuals becoming millionaires without really even realizing it. Alright, so that's great and all, but the issue at hand and for today's video is that new first-time home buyers are sort of in a tough situation, right? Where on one hand, it might seem like you're overpaying in a rapidly inflating market, but on the other hand, well, renting indefinitely is a guaranteed wealth incinerator, right? I've been there renting for years at a time. It can definitely feel like it's hard to get ahead financially when you're giving thousands of dollars away each and every month to a landlord. So of course, one of the first things that probably comes to mind in regards to trying to cool off this rapidly inflating real estate market is playing with interest rates. Basically, when mortgage rates go up, well, it becomes more expensive to borrow. And so the money that you had saved up or that you're qualified for in order to purchase a new house isn't going to be stretched as far. So overall home affordability goes down, right? So let's take a look at an example. A $720,000 home with 10% down over 25 years to pay it off would be $2,587 a month on a 1 1.2% interest rate. Now that same mortgage with a 25 BPS increase would be around $2,664 per month, which is $77 more on a monthly basis. And then finally, the mortgage payment on that exact same home with a 5-year fixed rate mortgage at 2.59%, well, now you're looking at $3,033 in monthly mortgage payments, right? So that's almost a $500 difference, which can be a lot for most people. That's honestly a big difference. And the way I see things is that although I do think this will start being priced in over the short term, where it's really going to make the most profound impact is over the next 3 to 4 years when 5-year terms are up for renewal. Even though this is considering a higher stress test that the Bank of Canada has put in place over the past year. We're not in 2008 though, where you can get $2 million worth of mortgage debt based on $35,000 a year salary. Things are different. That's really what all of this comes down to: supply and demand, right? Nothing more than what you learned in your Economics 101 class in grade 10. Right now, there is simply not enough supply and inventory on the market in order to have any type of price consolidation, despite all of the efforts that we're going to be speaking about shortly. All of this is driving upwards pressure. And based on all the research I was able to do on my end, there would need to be around double the amount of inventory currently on the MLS in order to start stabilizing price points. Now, ironically, more people tend to follow the American financial news than Canadian financial news, so chances are you've seen the American Federal Reserve starting to raise interest rates to cool inflation, but then also their housing market, which is also quite frothy right now. This, of course, is having an impact on the 30-year fixed rate mortgage, which has now surpassed around 5%. Back up here in Canada, though, the Bank of Canada has started raising baseline interest rates, which they started in March. That was actually the first time since 2018, and they plan on continuing to raise interest rates for the foreseeable future. The next rate hike being announced on April 13th, which in theory should both tame the insane inflation that you're seeing at the grocery store, buying 7 items and it costs $80, but then also that's going to most likely have an impact on price points for the housing market. In fact, the Office of the Superintendent of Financial Institutions, which is Canada's financial regulator, has warned that they believe Canadian home prices could fall in the range of 10 to 20% depending on the market if interest rates do continue to rise, which of course they will. Now, whether or not the housing market does end up dropping by 10-20% depending on the geographic area, ultimately no one really knows. And in fact, if we take a look at historic data, although this is down in the United States, interest rates are not necessarily fully correlated with price points, right? Although this would make sense, this hasn't been something that we've observed historically. Now, if the market were to drop by, say, 20%, personally, I would actually welcome this. So if you're watching this and you're a first-time home buyer, chances are you would absolutely welcome this as well. But even from an investor standpoint, I'm planning to invest in real estate for the next 20, 30, probably actually 40 years, or maybe even longer, right? So I'm in this for the long term. If I see over the next couple of years, price points drop by 20%, I'm in this for those cash flows and that property appreciation over the long term regardless. And so with this in mind, despite the fact that right now the idea of purchasing your first rental property or your first home might seem like a pipe dream and seem like extremely unfeasible considering current price points, in reality, this should be the time when you're trying to learn as much knowledge and gain as much information as you possibly can so that you can make an acquisition over the next couple of years. If you're interested, by the way, in my full 10-step process for purchasing your first property, make sure to check out the first link down in the description. I made a full free ebook for you that you can check out, outlining from A to Z all the steps necessary that I personally took from knowing nothing about real estate to building a team, acquiring my first property, and repeating the process. Again, you can check that out down below in the description, and it's completely free. Okay, so of course we need to speak about the new 2022 federal budget that was just released a couple of days back, and it's currently making headlines. So the first thing is the introduction of this new tax-free, what's it called, first home savings account, and basically it's kind of like a mix between a TFSA and an RRSP, where over the lifetime of your account you'll be able to contribute up to $40,000. This is going to be tax deductible in the years that you make contributions, and from that, actually the contributions yearly are $8,000, meaning that if you were to fully max out this account, it would actually take 5 years to do this, right? 8 times 5, $40,000. And to note though, the $8,000 contributions are not carried over year. So let's say this year I put $8,000 in, next year I don't make a contribution, the year after I can only put an additional $8,000 in. So this is basically allowing you though to grow your investments within that account on a tax-free basis like the TFSA, but then also again, when you're making those contributions, they're tax deductible in the year that you're making them from your total taxable income. So here's the thing though, I'm not gonna like roast the account. It's still a step in the right direction, I think. However, 5 years from now, who knows where the real estate market is going to be, right? If you want to fully max that out at $40,000, again, it takes 5 years to accomplish this. And then also, you're not able to combine this new account with, say, the first time homebuyers plan that you can get from your RRSP, where you're able to deduct $35,000 tax free and then repay it back. So you can't combine them together. As an individual, if you're doing this alone and not buying a house with a spouse, for example, you have $40,000 in 5 years that you're able to put towards a house. Now, let's consider this for a second, okay? $40,000 on, say, a $500,000 house. Sure, you're able to make that slide with a lower down payment, but if you're in one of these crazy markets like Vancouver or Toronto, where average prices are $750, $1 million, well, that's not really going to cut it for your first down payment, right? So this is kind of one of those things where, sure, it's a step in the right direction, but ultimately, I don't really think this is going to have much impact for most people. And considering the fact that although this isn't financial advice, I always try to recommend that if you're able to, putting as little down as possible on your property to get your foot in the door early. That usually is 5% down on an owner-occupied property. So in this case, though, if you're in, say, Vancouver, Toronto, and you're looking at a house that's like $1 million, well, above $1 million, you're actually not able to go and get an insured mortgage loan, meaning you have to put that minimum 20% down. So even if you were able to put 5% down, that would represent $50,000 as your down payment. That right there is above that $40,000 of the account. And again, it's in 5 years that you would even have that full amount to start investing with and putting towards a house. Number two, the Liberal government wants to build a lot more homes over the next decade. So they're planning to spend $10 billion over the next decade to double, first of all, the pace of homes being built to 400,000 per year, up from the current roughly 200,000 homes that are currently being built. Here's the thing, that's definitely very ambitious and would, again, be a great step in the right direction. However, there's a couple issues that I can just identify firsthand. First and foremost, the fact that this is going to be mainly, they're saying, for affordable housing projects, fixing repair backlogs, and then encouraging people to renovate their homes. Okay, so first of all, the fact that in most municipalities, well, it's not the federal government that has any say on building new properties and building, just new properties, right? So, for example, I am currently trying to add multiple units to multiple of the properties that I own. It is taking more than 6 months in the municipalities in order to get approval for this. If you're looking at a 200-unit building, it can take 5, 6, 7 years getting all the approvals. So it's not necessarily throwing more cash at this that's going to solve the problem. There's major backlogs across the country. That's number one. Second thing is major shortages, right, in actual labor. So I have multiple friends who work in the construction industry trying to find qualified labor that is actually skilled and able to build houses and work on certain trades is in huge demand. So again, we need more labor in order to supply 400,000 homes like they're planning on doing. Now that also raises another issue. In Canada, we rely mostly on immigration in order to grow the amount of population that we have in the country and continue growing our GDP over time. The thing is, construction has failed to keep up with the pace of immigration across the country. So in 2019, Canada had over 340,000 new permanent residents come to the country. And over the course of 2020, we've had 185,000 new people coming in. So that's over, 500,000 people coming in over the past 2 years alone, 2019 and 2020. And immigration accounts for 100% of Canada's labor force growth as of right now. That's based on Statistics Canada. So it's kind of like this catch-22, right? Where in order to grow as a country, we need to have more immigrants coming in. However, we don't have enough room in order to house all these individuals, which is further leading to upwards pressure on the housing market. Bottom line, this again is like running on a treadmill, and a new savings account isn't going to solve this. The third measure is a temporary 2-year ban on foreign buyers buying up Canadian residential real estate. Now again, I don't think this is a bad thing. I do think that this is going to make it more competitive for actual Canadians to be able to buy up residential real estate. The problem though is that, again, based on Statistics Canada, only around 5% of properties in Vancouver and Toronto are owned by foreign buyers in the first place. So this is definitely a good thing, but in the big picture, is it going to make a huge difference? I'm not sure, right? Again, I don't live in Vancouver though, so maybe if you have more insight, you can let me know down in the comments. And finally, the fourth main thing is a crackdown on flippers, where anyone who's purchasing a property and flipping it, selling it within 12 months of ownership is going to be subject to full-on taxation on any of their profits. So instead of paying capital gains, for example, it would be deemed 100% personal business income that's fully added towards your taxable income. Of course, this would make a difference, but the thing is, if you're someone who's flipping a lot of properties anyways, you're deemed in the eyes of the CRA a flipper who is doing this for active business work. So even as it stands right now, anyone who's an active flipper isn't paying capital gains tax in the first place. So all in all, these new measures in the 2022 federal budget, I don't think are going to be enough to really move the needle on bringing down overall home prices. And I could very well see prices remain extremely high for the next couple of years, at least until we see mortgage rates really starting to pick up and severely impacting people's ability to purchase homes. Now, if you want to learn more about real estate investing and personally what I have done over the past couple of years, make sure to check out my full real estate investing playlist on YouTube. I have legit gems on there going over all of the steps I've personally taken, going into the numbers more than I've seen anyone else do on YouTube, just fully transparent about these concrete numbers on my properties. So make sure to check those videos out if you're interested. And also don't forget to check out the links down below to free resources that I use, recommend, and also some like free spreadsheets that I've made. They're completely free for you to download. So thanks a lot for watching. Make sure to drop a like, subscribe to the channel. And with that said, I'll see you in the next one.